Okay, so now we go to the next question. So this question requires us to prepare the retained earnings, basically the statement of changes in equity. All right, so the retained earnings, the revaluation surplus, and non-controlling interests columns. Right. So let's first of all talk about the principles, retained earnings. So we have a column for retained earnings, and it will have a balance at the beginning of the year. So what is this retained earnings columns made up of? So it's made up of the retained earnings of the parent, right, at the beginning of the year, right? And this would have to be adjusted for any unrealized profit that the parent, if the parent was a seller, so this could be opening inventory, or if the parent was the seller of a depreciable asset, right? We need to remember that the parent would have recorded all the profit at the time, all right? And then we need to reverse that. And so we're going to reverse all the profit that was made on the sale of a depreciable asset, and then give the seller the portion of depreciation realized to date. So there's going to be an adjustment in the retained earnings. So we're going to take the retained earnings of the parent at the beginning of the year. And if the parent was a seller of inventory, we adjust for the unrealized profit in opening inventory. If the parent was a seller of a depreciable asset, we adjust for the unrealized profit, the depreciable asset. So this is the principle, right? We're going to be doing that. Then we go to the retained movement, not just retained earnings, but movement in the retained earnings of the subsidiary since acquisition. So since acquisition to the beginning of the current year. So we're going to say the retained earnings of the subsidiary, beginning of the current year, minus the retained earnings of the subsidiary at acquisition. This is the movement, right? So we're going to have that movement. This is the total, and that movement should be adjusted for opening inventory and depreciable assets, unrealized profit, if the subsidiary was the seller. So we're going to look for those cases where the subsidiary was the seller, and then if it was opening in, if the subsidiary was a seller of inventory, we adjust for unrealized profit in opening inventory, and also for unrealized profit in depreciable asset if the subsidiary was a seller of depreciable asset. Then from that adjusted retained earnings, right, we give the parent its share. So in this case, that would be 70%. So that 70% would form part of the retained earnings at the beginning of the year. So that's how we get the retained earnings at the beginning of the year. And then, of course, then we're going to add share of profit for the year, right, and subtract dividends paid by the parent, right? Here is profit for the year, allocated profit, and subtract dividends, and then that's what we have, the retained earnings at the end of the year. So it's not too difficult, and the same applies to, what else do we have here? Revaluation surplus. The same applies to revaluation surplus. Right. We're going to take the revaluation surplus of the so we have a revaluation surplus column. Now, revaluation surplus doesn't have adjustment. So we're going to just take revaluation surplus of the parent at the beginning of the year. Right. Then we take the revaluation surplus of the movement in the revaluation surplus of the subsidiary. All right. And then 70% of that, or a portion should go to the parent. So that's going to be the revaluation surplus balance at the beginning of the year. For NCI, we have explained this, but we will explain again for emphasis. So you start by share of the NCI. NCI's share in the equity at acquisition, right? So the NCI will have a share in the subsidiary. We determine the subsidiary equity, then we determine the NCI share we're going to give it. Then that will be ordinary shares. Then we also have a share, NCI share in preference shares, right? Nice. Then we can have also a share of the retained earnings. The same way, those retained earnings we calculated here, right? Where we say they have to be adjusted for opening inventory or depreciable asset and realized profit. Then the adjusted retained earnings, the NCI will have its own share. So it will have a share of adjusted retained earnings of the subsidiary, right? And then it will also have a share of revaluation surplus, movement in the revaluation surplus of the subsidiary only. Remember, the NCI is an investor, is a shareholder in the subsidiary. So it will only have a share in the subsidiary. Then we subtract preference dividends paid to the NCI. Then we subtract the ordinary dividends paid as well, like that. And then we will have the value of the NCI at the end. So these are principles that we need to look out for. So in this particular case, let's start with calculating what? Revaluation surplus. I think that's the easiest of them all. So we want at the beginning, so if we're going to do the revaluation surplus column, right, we start from the beginning. So if this is our revaluation surplus, it's 1,570 and 840. So we are told, right, that what was the revaluation? Right, the parent did a revaluation of 700 during the current year. The subsidiary revalued land in January 2022 for the first time since acquisition date. No other revaluations occurred. Right. So what we're going to do is we need to look at the subsidiary. So we've been told how much was the subsidiary, the revaluation surplus of the parent, right, during the year. So it's 700,000. So we have a balance here. It doesn't show you that it's at the beginning because the revaluation has been done. So this will be a balance at the end of the year, 1,570. 1,570. 1, 2, 3. And then we know that 700,000 was for the current year. All right. All right, so 1570 less 700,000. So which means that at the beginning of the year, it was 870, right? That is what we want. So the valuation surplus of the parent at the beginning of the year is 870, right? Now let's talk about the share of revaluations, the share of the parent in the revaluation surplus of the subsidiary. So on acquisition, the revaluation surplus, where is it? So the retained earnings was 760 and the revaluation surplus was 230 on acquisition, right? So, but now, because the revaluation was done, if you look here, on January 2022, which is the previous year. So there's no revaluation during the current financial year. No other revaluations. Okay. So that revaluation from 230 to 840,000, right, minus 200 was done previously. So it will form part of the opening balances. So that's 610,000. And of that 610,000, the parent has 70% share. So 427 plus, what is that? 427 share plus 870 at the beginning. So I say plus 870. All right. So that's what we have, 1297. Right, so if we start with the revaluation surplus, we start with 1297 at the beginning, then the current year it's 700. Right, and then at the end, that's what we have. Revaluation surplus is an account that belongs to the parent, the owners of parent, the shareholders of the parent. Let's go to retained earnings. Our starting point, like we said, is the retained earnings of the subsidiary, of the parent, rather. Right. So let's go to the retained earnings of so at the beginning of the year, this is 2970, right? So this is what we're going to do. Right, retained earnings. This is a calculation, right? So retained earnings of the parent, the beginning of the year. So we look there, it's 2970. So that's our starting point. 2970123. Then any adjustments, was the parent a seller of anything with unrealized profit? So we look at the seller, was the parent a seller? So we look at bike selling anything which produces unrealized profit in the previous years. So Bike Limited sells motorcycles. So we are interested in opening inventory, unrealized profit. We're going to subtract that. So at 31 March, it was 230. Right? So we say 15 over 115 multiplied by 230,000. This has to be subtracted because it's not yet realized. So it's at the beginning of the year. It's still in opening inventory. It's not yet profit. 15 divided by 115 multiplied by 230123. Right? And that's 30,000. Right? So we'll subtract that. All right. So I hope you can follow that. All right. So we subtract 30,000. Good. Now we got the movement in the retained earnings of the subsidiary. So at acquisition, the subsidiary at the beginning of the year, it's 2550. At acquisition, it was 760. So the movement is 2550 from 760. Right. And so the movement there is going to be equal to 2550 less 760. So the movement is 1790. Right, 1, 2, 3. So this is the movement in retained earnings, but we need to adjust that to say, right, was the subsidiary a seller of any unrealized profit? So we remember that the subsidiary sold some equipment last year, because remember we want there's anything that was sold which had an effect last year. So it sold something for 630,000, and the carrying amount was 450. So 630 minus 450. Right. And the depreciation rate is 20%. Remember, we said November, December, January, February, and March, 5 months. Right. So we said the profit was 180,000. So we need to subtract that because the subsidiaries recorded the full amount in the retained earnings. We need to remove this to say this is out. The profit on sale is out. Then we need to add the only amount that has been realized by end of last year, right? The amount realized is therefore 180,000 multiplied by 20% multiplied by 5 over 12. Multiplied by 20% multiplied by 5 divided by 12. So it's 15,000 that should be added to this guy to say, right, this guy is a 15,000. And then we remember that there is also dividends from previous years, right, which were not paid. So those dividends have to be taken care of, right? The preference dividends. So it's 300,000 for the year multiplied by 8%. So that's so this is going to be added, this is going to be subtracted. Right. So if we do a calculation there, we have 1790123 less 180,000, because this is not yet realized, plus the portion realized, which is 15,000 of depreciation up to the beginning of the year, which is basically depreciation realized in the previous year, minus 24,000 outstanding. So I get 1,601,000. This is the movement in retained earnings, 1,601,000. Now, 70% of this goes to the parent under retained earnings. 30% of this goes to NCI, right? Then, so basically that's all we have to do about, so how much will we have? You say 1,601 times 70%, right? So where is our statement of changes in equity? Because now that's a lot of information, right? So that is B. So this amount here, plus 1,120, right? 1,120 goes to what? This is the 70%, right? Of the adjusted retained earnings. And this amount here, how much is this? It's 40% times 24,000, right? that was in arrears should go to the retained earnings as well, because it belongs there. This is the share of the parent's retained preference dividends. So this is the balance of the retained earnings at the beginning, but we have to adjust for unrealized profit. So we end up with this is unrealized profit in opening inventory. We end up with 4070, right? Then for I think so. Then this profit for the year that we have to go back to the profit for the year, which we calculated earlier. Remember, we started by doing the, all right, so where is the share? This is the share, 3787415. So that's the share, where is the, so that was the share, the share was what, 3037. Now let me just look at C here. Let me write this share down. So the share here is 3787. 378,7415. So that is what we shared is the share. But this is a share of total comprehensive income, right? Now remember, under retained earnings, we only wanted a share of the total profit. So the question here doesn't split between share of profit and share of the comprehensive income. It just says share of total comprehensive income. So this is the share of total comprehensive income, but under here, we want only the share of profit. So we have 37, which I have 3787415. We subtract the revaluation surplus to say that's not part of retained earnings, right? So we have 378. Apologies. Less 700,000, right? And then you have all right, and then you have what you have there, 308,415. Right, so this is the share. That is, so it will split the share here. I don't know, what is this calculation about? I did a separate calculation here. Right, so we just said the total comprehensive share of total comprehensive income minus share of revaluation surplus. Then we get the profit for the year share, right? So that's not even difficult. And right, then retained earnings. Don't we have any ordinary dividends paid by the parent here? Because under retained earnings, we only deal with dividends paid by the parent, right? So there's no ordinary dividend paid by the parent, then we subtract that and we are good. Now, when it comes to the NCI, apologies. NCI is very easy, right? We start by calculating. So I'm just going to the what's this called? The analysis of owner's equity, so that I don't have to go up and down picking figures that we already have. So we first of all have to get the total, which is 1740, right? Total equity, share capital of subsidiary, retained earnings of subsidiary, revaluation surplus, or on the date of acquisition. So that's 1740 times 30%. So that will be 522,000. And then it will have a share of the retained earnings, just 30% of that, right? Um, then it will also have a share of the revaluation surplus. Then when it was done, right? Then it will also be, so we'll have 522 plus the share of retained earnings at the beginning of current year, because the starting point is to get a balance brought down. Then a share of revaluation surplus, um, current year profit is out. Then also a share of preference shares. Why is it? Don't we have preference shares here? Right, it's here. So just 60% of 300,000. That's 180. Right. So don't worry about all that. It always comes to big to 180. Right. So that's our NCI at the beginning. And then during the year, we just give it a share of just give the NCI a share of its the revaluation surplus. All right. By the way, the revaluation surplus was only for the parent. The subsidiary didn't have a revaluation surplus. And then these dividends are based on the dividends declared by the subsidiary, right? So any dividends declared by the subsidiary, uh, any dividends declared by the subsidiary, the NCI is going to have a share. So on the dividends declared by the subsidiary, which is right, so it will be for the ordinary shares, that will be 30% of that. And for the preference dividends, that will be 60%. Right. That's our NCI. And then we are good to go. Right. So basically, that's how we do the stuff. And when it comes to your goodwill, that is, I think that is rather straightforward, right? Just how much was paid, total NCI, total consideration, and NCI. This is the amount. And equity, that's the amount. So the difference is going to be your goodwill. Right. We hope you guys have enjoyed this. And right, good luck in your hard work and preparation.